In this video, we'll talk about important things to keep in mind when considering your loan options. In general, borrowing money is a serious endeavor and should not be taken lightly. Borrowing money may impact your ability to borrow money in the future. When considering a loan, take special care to consider whether you can afford to repay it. When borrowing, a few key factors to consider are the principal, which is the amount of money you'll require, the length of time that you'll be borrowing money, called the term, the interest rate, and any additional fees your lender may charge you. The easiest way to compare loan options is by considering their cost, for which the primary determinant is the interest rate. Often, borrowing more money will result in a lower interest rate due to what is called economies of scale. Economies of scale refer to the cost advantage that exists when more of a product is produced. In terms of loans, a lender might charge a lower interest rate if it has a few borrowers each borrowing $10,000 instead of many borrowers borrowing $100 each, since the former situation will require less work to manage. Note, however, that the interest rate is expressed as a percentage of principal, so a lower interest rate may not necessarily mean that the actual payment is lower. 5% of $100 is still less than 1% of $10,000. Longer loans will usually result in a higher interest rate. This is because the money could otherwise be used to pay expenses or to be invested, if the money weren't being loaned. If the length of the loan is longer, lenders will have to wait longer to access the money. These higher rates, however, may not be linearly related to the length of the loan. That is, jumping from a 15-year loan to a 20-year loan may not have the same impact on interest rates as jumping from a 25-year loan to a 30-year loan. Before signing a loan contract, consider how much you will be paying in additional fees. With that in mind, don't be tricked into thinking that lower fees are a great selling point, because your lender may make up for lower fees with a higher interest rate. When shopping for a lender, you may find it useful to know your credit score, because most lenders make decisions based on them. Borrowers with a higher credit score should receive lower interest rates because the lenders have more faith in the repayment. In the US, personal credit scores are generally determined by three agencies: Experian, TransUnion, and Equifax. Other factors to consider before borrowing money include whether the interest rate is fixed or floating. If it floats, make sure to look at the schedule of when the rate changes and which benchmark interest rate index your rate is tied to.